All right, well, welcome back to the iWealth podcast, and today we're talking about interest rates, and in particular, everything is costing more, and there seems to be a ton of noise out there right now, basically around interest rates. As an investor, right, how does this change my strategy, or does it change my strategy?
Well, it can give you some angst with your strategy with what's going on right now. So, on one side of it, if you're borrowing money, it's not from an investment standpoint. Let's say you're going to invest in real estate. If you're borrowing money, your cost of borrowing just went up because the Fed is raising interest rates and it's going up. But it isn't necessarily tied to just what the Fed is doing. It's all really tied back to the 10-year Treasury. So I watch the 10-year Treasury just as much as I watch anything else. And as that ticks up, you're going to see 30-year mortgages and those type of things. But we're in a paradigm shift right now with interest rates. We've been in a very, very low interest rate environment, and it's going to affect a lot of us. It's going to affect the national debt. So if you're on Washington, D.C. and you're working, it's going to have an effect on your spending power and all those type of things, if they care, Matt. We won't get into politics today. But from an investment standpoint, if you own bonds, typically when you look at investments, you got cash, bonds, which are loans, stocks, which you own, okay? When you look at the bonds part, everybody considers that safe money. It's not invested in these risky assets called stocks. Well, we've got bonds down over double digits, over 10% this year. Yep. Because of interest rates going up. Bonds work in inversed. So if you think about it this way, if you had a bond in Mankato, Minnesota for the school, and it was paying 4% interest rate 2 years ago, and you bought it. You borrowed the school district $10,000, and they're paying you an agreed-upon 4% interest, okay? Fine. You're going to do it for 30 years. They're going to pay you your 4% all the way along, and then they're going to give you your 10 grand back after 30 years. That was 2 years ago. It was paying 4%. Today, let's say that you got Wasika is building a school, and they're going to issue bonds. They need money to build it. So now you have your wife comes in and says, I'm going to give $10,000 to Wasika as a loan, a bond, but Wasika's paying 4.5% interest. So she's getting 4.5% and you're getting 4%. Now, if you had to get out of your bond and wanted to sell it, no one's going to buy your bond, are they? Yeah. They're going to buy the one in Wasika is paying 4.5%. 4.5%. That means you need to accept less for your bond. Bonds are issued at par, which is called 100. You might have to take 95 or 92 to get the yield up to 4.5%. So now people will want to buy your bond. So what's going on in this environment with interest rates right now is as you have interest rates rise, the old interest rates that these bonds were set at, the value has to go down to bring their rate up. And that's the inverse that we're seeing that's happening in this market. And so it could be temporary. I mean, things will wash themselves out. Bonds are inherently less aggressive than stocks. They just don't feel like it this year. And it's not different. We were here back in the 70s. It's just been a long time since we've been here before.
Interesting.
Yeah.
So you have a lot of people coming in and asking questions around bonds right now.
Yeah, well, their overall portfolio. So you take a 60-40 portfolio, 60% stocks, 40% bonds, and you're saying, why am I down 15%? Well, part of it is because your bonds are down 15% and your stocks are down 17% or whatever those numbers are. So you take the conservative investor, we're outside of their risk parameters temporarily based upon what's going on with this bond market right now in the interest rate environment that's going with the Fed.
Crazy.
Yeah.
If somebody would like a little hand-holding, talk me through that part of it.
Yeah,
because it's a little overwhelming hearing you talk through this.
It is, and I'm trying to make it. I'm trying to put this in context where people can understand why this is happening. But I think the best thing somebody needs to do is just have a conversation. Call our office, call your advisor you're working with, and have them explain to you what's going on with your portfolio. How much is in bonds? How much is in stocks? How are they down relative to the market? And then it might actually give you some peace of mind knowing, I'm down 15, but the market's down 22, Yep. But just get educated on it. There's a lot of articles out there, but it's tough to understand, which is why I thought it'd be good for us to talk about it today.
Go through the bond thing because it's so unique. I just haven't seen it since the 70s.
Right.
That's a long time.
Yeah.
So.
Yeah.
All right. Well, we'll see you back here sooner rather than later.
All right. Thank you.